Good morning, good afternoon, good evening, everybody. Today is Monday, December 7th, day of infamy here on capitaldiscussions.com. It is 12:30 Eastern Time, and my name is Jerry Furst, founder and director of InvestorsEducationNetwork.com. And this is the beginner trading group on Capital Discussions. And this is a live screenshot from this morning. And what we do is we talk about the week ahead, and then we also get into actual discussions of topics of interest, whether you type them in. And I also have today what I want to talk about is the beginning of a multi-part series, whereas stock replacement using options and the cycle, where you consider using options instead of owning stock, and then how you can go ahead and sell cash secured puts once the market comes to you and you are assigned the stock because the cash secured puts are assigned. Then you can go ahead and write covered calls once you own the stock, and you can also potentially hedge around that as if you feel that the market or that individual stock might be in jeopardy of going down. You can hedge around it either with puts, putting on a collar, or you can hedge your portfolio using an index ETF or a futures ETF or futures directly. And so, all right, very good, got you. Oh, wow, okay. You actually lost your entire Comcast connection. Okay, gotcha. So tune into the recording if necessary. Okay, we got one of our for those of you who are listening to the recording, we do record this. Let me go ahead and show you that if you go out to Capital Discussions and if you go into the library and you click on my name, Jerry Furst, and hit the refresh button, what you'll do is you'll get to see, here we go. You'll get to see all of the past recordings. In fact, I have to update the comments from the previous recording and from November 30th. Last week, we went into the ADX DMI indicator, and it's actually pretty good. The last 30 minutes of last week, we went in deep into the ADX indicator. And so if that's something that interests you, go ahead and tune back into that recording. All you have to do is click on the date right there, and it'll take you out to the YouTube website. And I'll click on it again. And there you go. And so now you're on the YouTube website, and you should be able to go ahead and see all of the past recordings. And so I'll be updating. It can usually take a day or two to go ahead and render up there. So feel free to go ahead and maximize your screen. I'd be curious to know, also when you do look at the recording to know if you get this fuzzy rendering or if it's in focus. So feel free to contact me at jerrybfirst@yahoo.com. That's my email directly over here on the bottom. And with that, we're going to go ahead and get started. Please remember that none of the communications, either live or video or electronic, should ever be considered as financial or trading advice, strictly educational in nature. We don't endorse any specific trading instrument, activity, or speaker. And investing and trading involves significant financial risk, not suitable for everyone. Only trade with money you can afford to lose, and never make an investment decision or purchase a product or service before doing your due diligence. Thank you. So real quick, we've merged, we shifted from Wednesdays to Mondays, and so I'm merging the week ahead with the beginner groups, and so very quickly I'll just go ahead and show on the Capital Discussions website, you have the significant economic events that are deemed significant by Econoday. Please don't use this calendar alone as the potential volatility events. These are just scheduled events that Econoday has figured should be on your radar screen, but there could be definitely other worldwide events that are scheduled and take into consideration. So scheduled today, according to the Capital Discussions website, Tuesday, tomorrow, you've got the JOLTS report, which is a jobs layoff indicator. Wednesday, petroleum status report. Thursday, jobless claims, weekly jobless claims, import-export prices, and Treasury budget report at 2 o'clock. Friday, we've got the producer price index, retail sales, business inventories, and consumer sentiment. One of the websites that I frequent for details is Zero Hedge, and so front running, every day they give you, what's significant today. So today they recap the fact that Obama gave a speech to the nation yesterday. Clinton urges social media intelligence. Obama urges law enforcement for social media. NATO says it won't send ground troops to fight ISIS. And some kind of France elections yesterday, which I don't know what that's about. You can click on those links and it'll take you there. What's significant here is that none of that's really directly economic related. These are all geopolitical international issues for the most part, which, does not show up here on this screen. And it's important to realize that we are now in a global interconnected marketplace. Here we have European and Asian stocks at 7 o'clock in the morning. They're letting people know about the overnight markets. Oil dropped below 40, and at the same time, Turkey is detaining Russian ships in the Black Sea, and there's definite oil issues. It's interesting to see oil go lower as Moscow and Turkey are fighting over access to oil and distribution rights of oil. I actually just got a message now from an oil trader of mine. And what's he saying here? 20,000 barrels. I've got a friend of mine. He's been trading oil. He didn't think oil would drop below 38, or below 40, I should say. So anyway, Iraq may seek direct military intervention. So believe it or not, all of this really isn't interconnected to the financial markets. We do have oil as the major lubricant of the world global economy. Without oil, we don't get the ships to move products and services around, and then you wouldn't have your iPhones and computers to trade with. All right. Feel free to go ahead and ask any questions, and if you have any symbols of particular interest, go ahead and type them in as well. And down. Robert saying his internet connection from Comcast is going to be down for about 4 hours. He was logging in by his cell phone. Okay. And that's something else to mention, if we are in the beginners trading group, be aware that when you are involved in trading, you need to have backups, whether it's backup computers and backup internet connections. And one of the first things that I reach for, especially in fast-moving markets, and I'll bring up the VIX while I'm talking about that. In fast-moving markets, it's amazing how all of a sudden the broker connections either break down or slow down. And so you want to be able to have a backup on your cell phone to access your broker's web-based platform, and or your cell phone lighting up a Wi-Fi hotspot in the house so that you can go ahead and continue to run off your cell phone if necessary, which, believe it or not, it seems to work pretty good, depending upon your cell phone and your internet connection. All right. So looking at the VIX as far as the week ahead and also today goes, we're currently at 1660. We're up 1.79. That's a 12% move up in the VIX today. So this is on the S&P 500 volatility index. If we take a look at the S&P right now, we're down 19 points. The Dow's down 164. The Russell's down 14. And so what we had a ways back on the S&P 500 is we had this W pattern. We did break. We went ahead and we made resistance levels up here at about the 2111 area, 2120. And now we're putting in testing the 200 period moving average, and we have to make sure that we're not ready to go ahead and really take a nosedive, or if we're going to go ahead and make a triangle pattern out of this. It looks like the triangle pattern is somewhat intact. So now we have upper resistance on the S&P 500 and lower support. If I want to look at the Russell, we have more of a upward trend channel, and the Russell 2000 being 2,000 stocks instead of the S&P 500's 500. And so notice the moving averages are flat. Let me go ahead and draw over here. Notice when it comes to moving averages, look at both of these are basically flat sideways. And so price is stabilizing. And we have to see if we're going to break above these short-term moving averages, the 8 and the 22. Is what I have for short-term moving averages right over here. Or is this support level here, the supporting trend line, is that going to break down? In which case we could end up testing lower support levels. Okay, so that's the Russell and the S&P 500. Some other stocks of interest: Alibaba down 10 cents, Facebook down $1.13, Ling's down 360, S&P's down 2, Twitter's down 53, and Yahoo's 26. And let's see, Zune, if you could hold on a moment. Pause. Okay, I'm going to go ahead and pause the recording here for a second. I actually have to take a brief timeout, and feel free to. Oh, and we got, who else is here? Participants, attendees. Hans, okay. I'm going to make you a panelist. Just mute your microphone, Hans, and feel free to go ahead and type in your questions so that everybody can see your questions, or if you want to have that just to me privately, you can do that. What I'd like to do is please bear with me for a moment. I'm going to leave the option view screen up for a moment. I need to talk to somebody for, it may take 2 or 3 minutes here. I'll be right back. Thank you for your patience. Right now the recording's paused. All right, I'm back. Sorry about that. Thank you for your patience. And sound check. You all attendees, Hans. All right, Hans, you're back. Up. Okay, Hans, I'm not able to promote you to a panelist because you're using Flash. So I'm getting a message here. I can't promote you. So just be sure to type in your questions, and I'll be sure to see them. All right, very good. I'm going to hit the recorder again. I appreciate your patience. Okay. So we went ahead and we looked at the VIX, and we looked at the Russell and the S&P 500. And what I want to do is talk about the cycle of options as options as a replacement for stocks, ETFs. And feel free to go ahead and ask any questions. This is going to be what I want to do as a 3 or 4 part series. And hey, Brett, not a problem. In fact, where are you, Brett? Hold on, refresh. There we are. Make panelist. Yeah, I couldn't see you in the attendee list. Welcome back. All right, we're getting actually a late start here, so so you didn't miss too much. I'm going to do a series that's going to be like a warm up for my live meeting in South Florida, where I'm going to be. Let's see here. My next meeting here in Delray Beach, Florida, is going to be options and charting. Actually, Brett last week was asking if I would go ahead and discuss and show the ADX DMI indicator, and that went so well last week that I'm going to go ahead and incorporate that into my live presentation. But I'm also going to be talking about options to buy and sell stocks versus owning and shorting stocks. And the cycle is right here. How to go ahead, and I'm going to copy that right here and go back into my PowerPoint. And this is kind of the concept involved for the cycle. You find a stock that you want to buy. Now you can buy it outright. You can buy a call and wait for the market to come to you, or you can sell a cash secured put. Okay. And those are kind of like the 3 ways that you could potentially, let's see if I can slide this over here. Those are, and feel free to go ahead as I type this up live, feel free to go ahead and add in if I'm missing something or if you have some other ideas or options, so to speak. Okay. Now, once, let's say that you've got a stock, XYZ. Stock is trading at $100. You think that it's worth 100. You think it's going to go up, but you think that there's a good chance that we'll get a little bit of a dip. So maybe you can sell the 95 put In which case, let's say that you got $1. Let's just, use round numbers. Let's say that you sold the 95 put for $1. What would be your effective purchase price if there was a dip below 95? Your effective purchase price would be 95 minus $1, $94 for a stock that had been trading at 100. If you're one of those people that you hear a lot of people say, as soon as I buy a stock, it goes down. Timing is just a little bit either too good, or it just always seems to get it backwards. And remember, it's not always, it's just the pain feels worse than the times that you get it right. So the psychology of trading is just huge. So the concept is don't let all the times that when you buy a stock and it goes down get you down, because that's going to stick out in your mind the most. Psychologically, you need to go ahead and remember that you can't win all the time. Nobody bats 1,000. So that's why the strategy of selling a cash secured put is something that you might consider as a way to build a portfolio. And what I'm going to be showing you here is a cycle that actually a lot of hedge fund managers use. So the first step in the process is you identify the stock. Okay. Then you go ahead and end up, you see that the stock goes down. Stock goes down. And you get assignment, or you cover your cash secured put. And then you end up owning the stock. Now you're the proud owner of stock. And once you're now the owner of stock, you can now sell. Now you can sell a covered call. Okay. And let's say that you think that in this example, 110 is a good place to consider taking profit. So you could sell a 110 call if there's enough premium. This is always a problem. You need to make sure that if you're gonna sell a covered call, it has to be worth your time, or at least in my opinion. Usually, for my rule of thumb is for volatility stocks like momentum stocks like GoPro or Solar City, or other stocks that are, I want to see at least 70 cents usually when I sell a call or sell an option. If you're doing something in a Dow 30 type, blue chip type environment, you may take 50 or 40 cents, but in my opinion, you need volume. There are some people that I've worked with and coached that, they rightfully don't want to work with too much of their portfolio. They don't want to put $100,000 of Intel into their portfolio, but they think that Intel, or let's say Walmart, they don't want to buy $100,000 worth of stock. So that limits the number of shares that they can, afford to allocate to their portfolio. And so that makes it more difficult to sell for anything less than really 50 cents and preferably 70 cents. And that's a consideration that we can get into more in detail when it comes to selling a covered call. Now, at the same time, once you own the stock, let's go back up. Other considerations, once you own the stock, is protection. And so protection can come in many different ways. Once you own the stock, you can potentially put on a collar, and a collar equals owning the stock and then selling a covered call and using the premium of the covered call to purchase a put I can't see my cursor. It bothers me. Using the premium of the covered call to purchase a protective put. Or buying puts on a index ETF. Okay, now this is why this can be a multi-part series, because we'll go through some live examples as we work through this over the next few weeks. If we're going to go ahead and buy puts on an index ETF, if I'm going to go ahead and, let's say, do this on Walmart, we might want to do that on the DIA, which is the Dow Jones. If we want to do this on, let's go ahead and take a live look at the markets for a second. And we can see that the S&P right now is down 22 points. The SPY ETF is down 2. Notice that that's like an easy 10% differential on the index and on the percentage change. Notice net change. Let's take a look here. Stretch this out a little bit. Well, you get the idea. Okay, so you've got a 2-point drop in the S&P, 22-point drop on the index itself. It's about a 10% move for each one. And you've got the same thing pretty much with the Russell, where you have the IWM is down 2 points, and the Russell is down 20. Okay, so if we were going to go ahead and look for an example of an individual stock, notice I come up to my watch lists. I can go ahead and click on Russell. This is the Russell 1000. And if I go ahead and click on, well, any of these, let's say that I'm trading with Priceline, Google, Amazon, Chipotle, Interactive Surgical. Okay, these are good examples of Russell stocks. If I go up to my watch list and pull up the S&P 500, and if I sort by price, you have a lot of overlap, literally overlap here, right? Okay, but there's 1,000 or 2,000 stocks in the Russell indexes, even Russell 3000. But the S&P 500, you might go ahead and watch this. What's the difference? Here's a good point. So how do you figure out what makes the difference between a Russell 1000 stock versus a S&P 500 stock? So if you come into the fundamentals, and when you take a look at capitalization, okay, usually these indexes are market cap weighted. And so if I was to go ahead and sort by capitalization backwards, notice on the S&P 500 we have Joy Global, Fossil, CNX, Urban Outfitters, okay? Whereas if I sort on capitalization over here on the Russell 1000, you still have all of the same stocks overlapping when it comes to capitalization on top, but the capitalization of the Russell 1000 is going to include some with market cap a little bit lower. So in this case, the S&P 500 3D Systems may or may not be part of the S&P 500. DNR may or may not be part of the S&P 500. And so that's one way how you might differentiate between what stocks are in which index. The reason why we're talking about this is that I'm thinking in real time. If I was going to go ahead and work with 3D Systems, that would be a Russell hedge or an IWM ETF if you wanted to potentially hedge. As far as let's say if you're going to do Google, or let's say Amazon or Apple, Amazon would be more of that's like a NASDAQ and S&P 500. The problem that I have with the NASDAQ, once upon a time, the Qs used to be, the great trading vehicle. But then you had stocks, just a few stocks that overwhelm the index. And so Apple basically is the NASDAQ index, in my opinion, is the way I kind of look at it. But the S&P 500 has the SPY, and let me see if I can zoom in on that, make that a little bigger. Okay, home, and make it larger. All right, that looks a little better. Okay. Okay, so once you're the proud owner of some stock, I appreciate you bearing with me as I type all this in. Once you're the owner of stock, now you can sell a covered call, but you also want to consider protection. If you think that there could be a pullback, whether it's in the individual stock or the market in general. But the idea is that if you're going to, let's say, have a portfolio that's, if it has several Dow 30 stocks or several technology stocks or several, blue chips, you'll consider using the Russell directly as the S&P or the S&P 500 futures or the ETFs on those indexes. In the event that you might be into, let's say, biotechs, you may want to go ahead and use something like the BIIB or some other ETF that mimics the biotech sector if you want to hedge several stocks, if you're like really big into biotechs, for example. And hold on one second. I didn't want to cough in your ears. Now, Brett's Brett's saying that market makers are taking out stop losses, and that's an interesting comment. The New York Stock Exchange has recently said that as of, I think, the middle of January, they will no longer honor and will cancel all good till cancel orders. I think that that's part of the reason is that the stop losses are being used by, I would consider, less sophisticated retail investors, and the high frequency traders are like they're taking advantage of something where, for the longest time, people have been told if you have a 7 to 10% loss in a stock, get out. So even if you have a good till cancel order, it's like you're telling the market makers, hey, I bought this stock for $100. I'm willing to give it back to you for $95 to $90, 5 to 10% loss. And so rightfully, there's issues that need to be corrected, but by eliminating good till cancel orders, I believe that other exchanges will probably follow the New York Stock Exchange changes. What they do is they don't allow someone like myself to use stop gains. In other words, I like to put in, when it comes to my option trades, I like to go ahead and figure out, using OptionView, where my stock is likely to go first with, and this is really the other cycle right here. Let's say, for example, if I'm looking at Twitter, for example. And I have potential price targets on the upside, resistance of 30. And this is not a recommendation, strictly my analysis from me and others that I talk to in depth. Your risk and strategies may be different. So right now you can see that today we're down 70 cents, which is a 2.8% move down. We're approaching a Fibonacci and a just a flat-out regular technical support level of 24.20. Let's call it 24. Now, if I'm buying an option or selling an option on Twitter, I can use OptionView to go ahead and tell me that if that option goes up or down, how much that option is theoretically going to be worth at a loss, but more importantly, at a profit. Because the odds are that in periods of high volatility, it's much better to have your options that you want to either buy on sale at a low price or sell at a higher price. If you're the only person that has actual options available, you'll get a fill that might exceed your expectations. But usually these big moves in the market, they take place very quickly. Notice, like here, this is on Twitter, a 30-minute chart. Notice that if you did not act in the first hour of today, you may not have been able to capture the 24.20 range. And notice it went back up to 24.60. On $24 stock, you're not talking too much. What about Google? Or I should call it Alphabet. How many people, who can be the first person to type in what is the definition of Alphabet? Why did Google and their creators go ahead and change the name to Alphabet? Or at least it's somewhat of a mythology right now. Anybody? While you consider the concept of Alphabet, take a look here. We have moved down, spike up. This is a 30-minute chart. And in this case, Google's under pressure this morning and going sideways on a daily chart. And looks like it's had a beautiful run up to as high as 770. Is that 776? I'm going to cough again. Hold on. I don't want to cough in your ears. Okay. So Brett's saying Google was changed the name to cut the organization in chunks that could be managed and traded separately. That's correct. That is the technical reason why they have kind of restructured by name the corporation. But take a look at the name. Alphabet. Basically, in a way, these guys are too smart for their own good. In a way, you could say that all stocks are a bet on alpha. And so if you haven't heard that before, you heard it first from Jerry Furst here on Capital Discussions, founder and director of InvestorsEducationNetwork.com, just bringing it all back around in circle. But yeah, Alphabet. Yeah, those guys at Google, kind of scary in a way, but it is what it is. And their stock reflects a portion of their genius. This is a great example in a way. If you wanted to consider a stock that's traded as high as 770, 780, it has a nice gap, okay, right over here that comes down to about 670, okay? So how would you like to own Google at 670? So this would be a, let's say that, you would be willing to, if you're managing a portfolio and you wanted to manage 100 shares of Google, 1,000 shares, you're a hedge fund manager to a degree. What would Google be like as far as, just a quick example. Come on now. GOOGL. Ever since they split it in two, I basically have shied away from trying to figure out the different. I know that one stock is voting class, the other stock is non-voting class. I'm not sure if my vote would count too much if I owned a few shares of Google, but I can tell you that when it comes to Google, take a look at the volatility chart. If we take a look at the daily chart, the volatility is not like it used to be, but take a look what it used to look like. When we came around for earnings, it's like an EKG. This stock is extremely interesting, and I assume it will become interesting again when the momentum and everything picks back up. Notice it goes up into expiration. One of the other things is that Google typically has earnings announcements on a Thursday, so you can go ahead and buy options the week of earnings, and so the volatility goes up and comes down with earnings, goes up and comes down with earnings, goes up, comes down with earnings. And this is extremely significant because if you're an option investor or trader, knowing the volatility crush being predictable is something that you can take to the bank sometimes. And I've had some of my most successful trades with Google using this earnings trade. Notice that the volatility is not as pronounced. It's still there a little bit. You can see a nice drop in October of 2014. Here we have, looks like the volatility crush again right here. Okay. So it's still working, but by the time most people catch on to something as a regular pattern, the pattern ends up becoming broken. So that's one thing to consider. But we have a stock trading at 770. So here's an example in a way that, let's say that you want to go ahead and buy 1,000 shares. Let's just use a round number. Let's look at option view here. notice you have net requirements and gross requirements on the bottom of the screen. If I pull up my chart, I can see that we have a gap to fill at about 670. So if I go down to 690, and I'm going to define that I only want to see the regular options and the quarterlies. That's going to clean up my screen a little bit, so I may bring the weeklies back into the picture, but for now, let's keep it a little bit simpler for demonstration purposes. And so now the January 690s, I could sell for $2.55. So within 40 days, I can either keep that money or I can buy it on sale for $690 minus $255. This is the market price. This is the legend right up here on top. Here's how the legend works for those of you who are not used to option view. I can configure this matrix any way I want with all of these different parameters. The way I have this grid set up, this 3x3 grid, I have market price, theoretical price, open interest. On the second row, the bid, the ask. And then if I'm going to consider a trade, I can put in the number of contracts that I consider I might want to buy or sell, the delta, and the midpoint implied volatility. If I wanted to make a trade, then I would have an existing position box, and there'd be a number, the trade would change from a trade to an existing position. So right over here, what I'm looking at is January has 40 days until expiration. The 690 put, what happened? How'd that happen? All the way at the bottom. The 690 put, which is as far down as the matrix has it right now. I could bring more data in, but I'm not. So it's 690 minus 245 would be just call it 687. That would be a nice discount for a stock currently trading at 770. If you thought that 770 was a good price to buy, why not go ahead and at least put the money in your pocket, especially if you think the market might be dropping and you don't want to be holding the bag, so to speak, if Google was to have some air taken out of it. So if I was to go ahead and sell 10, watch this in the bottom where it says net requirements and gross requirements. If I sold 10 contracts, that would effectively allow me to control 1,000 shares, or I have the obligation to purchase 1,000 shares. It's saying that I would have to have net requirements of about $106,000 gross requirements in order. So my broker, based on my parameters in my account, as far as margin requirements, I would need about $100,000. Okay, and just to go ahead and show you, if I was to put this into a demo account, beginner trading group, and I convert the trade, notice it drops from this box here, which was the trade, into the existing position. And this is what the risk-reward graph looks like. I have profit at expiration. You have this dashed line. Notice the 5 expiration dates. I have these expiration dates right here, and I can adjust the time decay lines very quickly just by typing in a new date inside this box. Notice it starts at December 7th, December 17th, the 27th, the 6th, and the 16th. I can go ahead and bring that down to just two or three time decay lines, and then this is an expiration. And I can also adjust the volatility very quickly. And so at expiration, my break-even point is $687. It's saying that I'm going to need about $100 about $100,000 of margin requirements. And at expiration, I would have put about $2,500 into my pocket. But also look at this. If I click over here on this second time decay line, that is December 27th. And on December 27th, my break-even point is $739. Big difference. Big difference. So if I go ahead and bring in some more time decay lines, you can see that as of January 6th, with 10 days left of expiration, my break-even point is $719. Okay? Okay, now, you have all your Greeks, your delta, gamma, theta, vega, maintenance, and profit and loss down here in the numbers below the risk-reward graph. And then if I was to go ahead and hit the D for details button, and if I was to say today, which is T, plus let's say 14 days from now, if we were to drop down to 695, okay, I would have sold these puts for $2.47, but the theoretical value would be $16. Now, I'd be on the hook for $13,000, right? Okay, but watch this. Watch this. Let's say that I just bought right now today 1,000 shares. I convert that trade. Okay, notice this legend box, we're trading at 770. The trade goes to existing position. And now, if I only click right here, notice the color changes. I can isolate that trade by itself. And this is what your risk-reward graph looks like if you only buy and sell stock. So now, notice that the requirements, the gross requirements, is $385,000. And that's instead of about $76,000 to $100,000 gross requirements. Big difference in gross requirements. Now, on the risk-reward graph, if we said today plus 14 days, if we were to drop down to $695, we would be down $76,000. Okay? What's the difference between the two? Well, we can go ahead and put them both together. I'll unhighlight that one stock option or stock purchase. I'm going to go ahead and analyze the trade. This is actually combining both positions, and I have a little button here. I can abbreviate that, especially for complicated butterflies or whatever multi-leg trades. It's better to abbreviate. So here we're long 1,000 of the common stock, and we're short 10 of the 690 puts. So if I hit the detail button now, and if I say today plus 14 days from now, if the price goes down to $695 with no change in volatility, which isn't true, the odds are the volatility would probably go up if the stock goes down. Well, you can see that if I owned 1,000 shares as of today at 770, 771, I'd be down about $76,000. If I sold the 690 puts, and if it went down, I'm only down $13,000, but I can now buy the stock for $695. Okay, so look at how much money not only did I not lose by selling the puts, but I can still hold on. The odds of being early assignment or having the stock put to me, usually small, unless if there's an earnings dividend coming out, especially something as liquid as Google. But you could be the stock could be put to you at any time when you do sell, and that's a consideration you have to be aware of. That's why you always must, if you're going to do, in my opinion, I almost never say never or always, except in cases like this. If you're going to sell puts, some people get lulled into a false sense of security where they think they found the Holy Grail and are going to sell naked puts until one day it's going to bite them in the butt, and they'll, be lucky if they can dust themselves off and come back to fight another day. Because when the market goes down very quickly and you can't get access, or if you have a margin call, if you don't have access to cover the margin call, or if you're not prepared, it can potentially push you out of the game. So be careful. Please be careful whenever selling options, whether you're selling calls or puts. So this is highlighting the difference 14 days from now if Google goes down to $695. What happens if it stays where it's at? Let's say that it stays at 770. Okay. In this case, if you sold the 690 puts for $2.47, time decay works in your favor, and the theoretical price of those options are now worth 98 cents. Okay, and that's over that's about a 60% return. Okay, even more. Notice you're up $1,460 that you can keep if you wanted to buy it back for 98 cents. If you wanted to buy it back early, if you had bought the stock, you still have your commissions, about 700, and you have your commissions, 770. So you're down about $1,000 or so. It's currently, I think when I bought it, it was at 771. And so here, watch this. Part of option view is that you have this transaction log, and so let's keep the math simple. If I go 770, okay, it's easier to work the numbers. So now if I hit the details button, and if we're at 770, come on. 14 days from now, not 144. One of the problems with option views that they have to fix, hopefully soon, is that there is a keyboard lag. And so I hope that they can fix that. So 770, you've got about that $1,000 is the, this can't be the commissions. Commission's only $14.95. If we wanted at 770, 771. Hold on a second. I think it has to it didn't change it. Okay. I had to back all the way out of the risk reward graph. Okay, so option view, I changed the price that I purchased 1,000 shares to 770. My commission is $14.95 for that trade. If I go ahead and analyze it now, it should change the numbers right. Okay, there we go. So 14 days from now, if we're still at the same price, I'm only down my commission of $15, $14.95. Okay. However, the time decay for selling the puts put about $1,400 in my pocket, and if it continues to stay above 690 through expiration in January, I get to keep all of it. And I can continue to do that again and again and again until I potentially end up owning the stock. Once I own the stock, then I want to consider potentially selling covered calls. But by the time we've dropped down potentially to 695 or whatever, everything else is going to change, and we might consider buying a covered call or selling a covered call at about 740 or so. Okay. So let me go back to the PowerPoint slide. So, so the idea, once again, is you have a stock, let's say Google, where you want to consider buying it outright, or you could just buy a call instead of the stock, or we could sell a cash secured put. So one of the things that I did not do is let's go ahead and compare those three. Let's say that instead of selling the cash secured put, let's say that at the money, 770, let's say that I was going to buy, because I think if I think that Google's going to go up, odds are I'm not going to buy something expiring in 40 days. I want to buy with time, so maybe I would want to buy the leap at 780, for example. Here's a 780 call. And maybe I want to control a stock trading at $770. I want to control it for almost 2 years for $120, $119.75. Okay, those requirements if I go ahead and analyze that trade, looks like this. Let's go ahead and I have 2 time decay lines. And I'm going to scrunch the chart up. And so for those of you, and let me go back, for those of you not familiar with risk-reward graphs, everything below the 0 line is a loss. Everything above it is a gain. If today, I click on this dotted line up on top, that's today. If today we go up 10 points from 770 to 780, you can see the wand right here. You could see that if I bought those leaps today, I would have a gain of about $4,600 with a maintenance requirement of about $89,000. Okay, you see the window on the bottom? As I move this back and forth, my profit and loss changes. Now, if that happened by December 28th, 2016, which is like almost a year from now, okay, after 1 year's period of time, if it hits 780, we'd be down about $30,000, but we probably would be taking more action to go ahead and buy and sell some other options or trade around it or sell covered calls. And here's the thing. Once you own the 780 calls, you can start synthetically selling covered calls above that. So I could go ahead and, for example, once I own the 780 call, okay, I could potentially sell the 800 as a covered call. And synthetically, it's as if I own the stock at 780, but I'm selling the 800 call. And now I can go ahead and as Google goes up or down, the value of these options that are good for about 2 years are going to go up and down as well. You can see the delta right here is 56, and the delta over here is 59. And you can react accordingly and plan accordingly based on those moves. And this is what the risk-reward graph looks like with that covered call. Again, this is not a recommendation. This is strictly talking and thinking of a potential way of using options as a replacement strategy for stocks. And then you slowly morph and build your strategies around that. Questions or comments? Questions or comments? Let's see. Brett, Okay, good. If good till cancel goes away, how do I sell a put to end up owning stock? Well, if good till cancel goes away, how do I sell a put to end up owning stock? As soon as you sell it, you're technically engaging in a contract. Remember, that's what they call these things, option contracts. And I point you to the characteristics and risks characteristics and risks of options that as soon as you apply to your broker to open an options trading account, believe that they're obligated and required to send you this booklet that can look intimidating, and I would encourage you to read it. It doesn't look like a book that you'd buy off the shelf through Amazon, but it does have a lot of valuable information as to how options work. And so if you were to go ahead and just buy a put, you've now entered into an obligation to deliver those shares. Yeah, it's more like a pamphlet, right? And it's kind of, it'd be nicer if they put it on better paper and a little bit easier to read. But the information inside there is extremely valuable. And they answer a lot of questions. They dot all the I's and cross all the T's for weird situations that could come up. If you're going to sell options, whether it's a call or a put, you have an obligation to deliver stock or buy stock. So if you sell the put, you've got an obligation to buy it at that price that's, in this case, lower. Be careful if you sell in the money options. They can immediately be assigned. You can, it's the market makers, if they ever see an opportunity to take your money, they will most likely take it. So just be careful. And if you're ever going to start doing this, I recommend that you talk to your broker as you're entering your orders until you feel comfortable doing it on your own, or consider contacting somebody like myself or some of the other coaches and mentors that are available to you, somebody who's objective and doesn't have a dog in the show. I just got a text message from an old friend of mine, and he's typical of some people that become cheerleaders. Once they end up buying a stock, they feel a psychological duty to tell me that I should own it too. And I found out a long time ago that I'm not going to be right 100% of the time. And so I only tell people what I see or what I might do if I was you. But I never want to tell somebody by Google, they're the smartest guys in the room, this thing's going to $1,000. Never would I say that. I would say that we have resistance at 780. And we've definitely got a 50-period moving average at 700, 698. And I'd say that if price breaks the support level of about 745, if we break below this 22 moving average at 740, we have very good odds, or at least a high probability anyway, that we could gravitate even lower to 700. And once we break that level, potentially filling this gap all the way down here, at 650. And that's something to consider because, in this example, I'm talking about selling the 690. And so in a fast-moving market, if we really break down, seeing Alphabet or Google drop down to the 650 level is a possibility. And if I sold a 690, I could be looking for what I call repair strategies. Other people call adjustments, and I call it adjustments too, repair strategies and adjustments. Repair strats. For those of you guitarists out there, repair strat. All right. a good example of how the markets are somewhat breaking down. You can see here the moving averages on Alphabet going sideways for the most part, the momentum slowing down. Take a look at Chipotle Mexican Grill. Here's a stock that I've had some fun with trading in the past, and I've made a lot of money with Chipotle. And one time I had some options where on earnings went ahead, and I didn't think that it would blow past 3 or 4 standard deviations, and that's why people who use iron condors really got to be careful. Anytime that you're selling options, just be careful because and always be aware of earnings. I think this stock jumped from 460 to 5. I think it was from 430 to 510 overnight, and so I thought that selling the 500 call was going to be safe. So anyway, remember, nobody's perfect. Okay. So E. coli is okay. So Brett's is the E. coli scare over with Chipotle? So that's my point. Okay. When we're dealing with options and stocks, it's sometimes it's about the story. Chipotle's opening more stores and they're doing this and that. And then you always have they got caught hiring illegal immigrants, or they have E. coli in a couple of stores and some things. So the idea is, if you loved Chipotle, if you like Chipotle, if you drive past their places and there's always a line, is this a buying opportunity? You have to answer that question for yourself. Is the E. coli situation overblown? I think so. I think but at the same time, look at the market in general. If the market in general, whoops, hold on one second. We're getting some audio bleed through. Okay. So if we think that it's overdone, that's possible. Take a look here on the weekly chart. Notice I'm always looking at multi-time frames, for example, with Chipotle or any stock. Notice the 200 period moving average is a magnet. This is not magic. It's a magnet. 508 being a target for Chipotle. Likelihood that it'll probably hit that 200 period moving average. It's a moving target. And will it bounce off of there? There's a good chance it'll probably bounce off of there. We can go ahead and put some Fibonacci's from this high to this low, and take a look and see if it coincides with that 200 period moving average. And did it? Well, it's close. At least what these Fibonacci's do, this 138.2 extension, this 123.6 extension, at least I have a target. And we're already below this one Fibonacci. You can see if I go ahead and put my cursor on here, you can see the Fibonacci levels. You should be able to see the Fibonacci levels. Oh, come on. It won't do it. Okay, too many levels. All right. So anyway, you've got 525, and you have 495. Those are big moves. And I would venture to say that you could probably pick up a couple of bucks trading above and below these Fibonacci's on a weekly chart. You'd have to conduct yourself accordingly. And that's where software such as OptionView comes in, where I can very quickly go ahead and see what my risk reward is and whether or not it's worth it, and then play the what if game. And in this case with Google, I'm going to convert this trade as well. And I can go ahead and isolate each one of these trades individually. Okay, So this is the risk-reward graph using the leaps with covered call. Okay. This is the risk-reward graph just using the January selling 10 of the 690 puts, in which case paid as long as it's a way of, it's kind of like you're paying yourself a dividend without owning stock, waiting for it to come down to you, waiting for the market to come to you. And here's what the risk-reward graph is just if we just buy the stock outright. And so and here if I was to go ahead and look at all of these trades together, this is where OptionView really goes ahead and comes in handy, because again, I can go ahead and look at each one of these individual legs, and I can go ahead and see the theoretical value of those legs, and I can consider whether or not I would want to buy it or sell it and close or adjust the trade based on different support resistance levels. All right. So that is somewhat of the cycle. I could buy the stock, buy a call, sell a cash secured put. I could also, as I was saying, I could also buy a leap for synthetic stock ownership. And I could also sell a covered call at the same time on the leap. I really wish I could see my cursor. Okay, so that's pretty much covering a lot of ground. And what we didn't get into are a lot of the details and specifics about how and what option to use and how and what type of protection to use. We just kind of went into briefly the buying section, the first phase, okay, phase one, in which Doris gets her oats, phase one. Okay. Sadly, tomorrow, December 8th, which is 1980, since John Lennon was gunned down, just as a little bit of trivia. And so that's part of the cycle, and that's going to be part of our multi-topic presentation for the next few weeks. But we still, I'm still happy to go ahead and engage your questions, whether or not they are focused on the topic at hand. And if anybody wants to go ahead and help out with PowerPoint, please send me a message. Brett, thank you for keeping notes. And again, go back over to the Capital Discussions website. And when you click on the library and the date with my name, Jerry Furst, you'll come out to the YouTube website and you can go ahead and revisit these webinars. And so here's Capital Discussions website. Click on Jerry Furst, hit refresh. You can go ahead and click on the date. November 30th was last week's presentation, and that'll take you straight out to YouTube. Maximize your screen. And I'd be curious if you do go out and look at it, I'm noticing, take a looky here. That's funny. I don't know if you heard that. The screen looks really fuzzy And I don't know if that's me and my settings for YouTube or if that's the way that the video is being rendered. So I'd appreciate if you guys go out and check that out. Let me know, because it looked like that's happening on on some of these other webinars from Capital Discussions. All right. Any other questions at this point? Do I have summary? Do you have S summary? What about FOMC for December? Brett's asking. Okay, yeah, good question. As far as I'm concerned, my guess is that the FOMC in September, they ended up holding things steady, but the December, it's Fed rates. Increase. Okay, up or steady. Row your boat. Up or steady. Okay. So with December, last week's non-farm payroll report came in surprisingly, or they say, whoever they are, that all the numbers look good. Everything's awesome in the economy, so most likely we're going to see a Fed hike in December, which is really interesting because if they do raise in December, it could put a damper on the stock market, and traditionally when the Fed starts to raise rates, it usually is the popping of a bubble. But the Fed is being very careful to let people know that if they do raise rates, they're not going to keep raising them one after another. In my opinion, most likely they're going to raise a quarter basis, 25 basis points, quarter point, and stop, just so that they can go ahead and shut people up and say, look, we raised it, so now that we raised interest rates, now we can go ahead and you can leave us alone. And so we'll see. That's going to be coming up in a couple of weeks. So stay tuned for that. In the past, they would typically start raising rates, but our economy is not representative of what things used to be. And if they raise rates, they're raising it on themselves, because the banks and the institutions are the ones that have. Imagine that you've maxed out your credit cards. It would be like raising your own interest rate on purpose. You'd probably not want to do that, especially when you're dealing with trillions of dollars. So even a quarter basis point move up can be extremely damaging to payments, balance of payments. They want to be able to lower rates down the road. It's very possible. Right now they don't. Interest rates are potentially going negative. They've gone negative over in Europe and some other places. So negative interest rates is a possibility, forcing people to take money out of the banks, out of safe harbor, and putting it into risky assets. Speaking of which, we'll go ahead and just take a quick look at the market. This is on the 5-minute charts. You can see that oil hit a low today of looks like 37.80. What's the low right here? 37.50 is the low for the day on a 5-minute chart. You can see gold had moved up from 1060 to 1088, and now it's back down 1075. So you are starting to see some movement in the commodities. On the S&P 500 and the Dow, let's see, the Dow's down 185, the Russell is down 21, and the S&P 500 is down 22 points. Today is December 7th, Pearl Harbor Day for those of us who they've started to take it off the calendar. I think it's still worthy of keeping our guard up in these days. Monday, December 7th. And my name's Jerry Furst, founder and director of Investors Education Network. Feel free to go out to investorseducationnetwork.com or traderseducationnetwork.com. Click on the top banner over there, and you can go ahead and get yourself a free 30-minute initial consultation if you're interested in private coaching and mentoring, whether you want to learn and shorten your learning curve, or even if you're advanced, just making sure that you've got somebody who's objective, helping to keep you out of the weeds, so to speak. All right. So with that, what I'd like to do is wish you all a good week ahead. And we'll see you next Monday here on Capital Discussions. Again, Jerry Furst from investorseducationnetwork.com. You can contact me, Jerry B. Furst at yahoo.com. Have yourselves a great week ahead. And with that, I'm going to end the recording.